At EY, one tiny question like, "Is there a better way?" may seem a drop in the ocean, but it causes a ripple effect that can spread out to the entire world. Every question we ask can build confidence in the capital markets, can help our clients grow, innovators accelerate, governments solve more complex challenges, and communities to thrive. All of these better questions on a huge scale create long-term value for our people, clients, and society that leads to sustainable, inclusive growth. Every better working answer ladders up to achieve our purpose of building a better working world. So, the question that you ask is the drop that starts the ripple.
Thank you very much for this fantastic video. It really sets the tone right about asking the right question or asking questions. I think very well said. This is Haroon Jan, the Regional Head of Member Affairs for ACCA. I welcome all of you yet again to this session on corporate income tax, which is a part of a series of tax sessions for Sri Lanka that we are doing under our 6 Digits program. Thank you very much for joining in. I am here to make a quick, brief announcement, and that announcement is with respect to a lot of demand that we were getting from all the participants about the previous recording links. So glad to share with you that the recording links today are available in the handouts. So if you look at the handout section on GoToWebinar, there is a document by the name recordinglinks.doc, which is available. You can download it, and this file has a list of all the sessions that we have conducted under the 6 Digits program so far, including the ones on taxation with EY Sri Lanka. So if anyone wants to view a session again, anyone wants it to be kept as a record, I mean, the links are going to be available, and you can review these sessions at any time, depending upon your availability. So that was an important announcement that I wanted to make. My colleague Feroz also share the link to this document. Also, I mean, we have placed this document on a shared drive also, and we continuously keep it updated. So it will be a good idea that you copy the link from the chat and keep it safe with you. And whenever you're interested in looking at the updated document, it will be available on the shared drive. You know, about the handouts, after every session, Feroz is going to update this document and is going to make it available in the next session again as a handout. So these are the two different ways through which you can get a permanent access to all the recordings of these sessions. So that was a little announcement that I had to make. This is a provision that is now available. So without any further ado, let me hand over to Roshni Fernando, who's our partner for EY and also, responsibly running the, the tax series from EY's behalf. So Roshni, over to you.
Thank you, Haroon. So good evening, everyone. Hope all of you are doing well. Like Haroon said, this is a continuation of our series on the landscape of Sri Lanka, tax in Sri Lanka. So we will be continuing on corporate income tax. I hope you all got at least a brief sort of an understanding of the exemptions and the tax rate structure in Sri Lanka. So I'm going to hand it over to my team. They will explain what we are going to cover today as well. And like always, please do raise any questions you have. We are happy to answer. Over to you, Roshan Akida. Thank you.
Thank you, Roshini. Good evening, ladies and gentlemen. It's a beautiful evening evening in Sri Lanka. I warmly welcome all of you joining from different locations and from different countries to this session on corporate income tax. This will be the second. Will be the second part of the seminar on corporate income tax. We had a brief session on corporate income tax law, which we will look at it just to recap. In our previous session, we looked at how to compute, how to identify various sources of profits and gains, and we discussed about assessable income and also taxable income. During the session, I explained when computing the assessable income, we arrive at the profits and gains and we do certain adjustments to the profits and gains from various sources in order to arrive at the assessable income. In this session, we will go into detail about those adjustments that are done to these profits and gains. So let us look at the content of today's session. We will look at some of the general and specific expense deduction under the Inland Revenue Act. We will also move into capital allowances and how to compute adjustments in respect of assets and asset disposals. We will also look at the complications surrounding tax losses. Then a very important area, investment reliefs. We will look at briefly on the tax calendar, that is the payment dates and the compliance requirement. We will end the session by looking at some of the tax developments which have taken place, especially which is applicable for year of assessment 21-22. So let's move on to general and specific deduction on expenses. When you say deduction rules, as the law permits, most expenses which are recorded in the accounts for accounting purposes are allowed. But some expenses have specific rules. So why do you have a specific rule is that expense requires that you meet certain criteria in order to qualify as a deduction. So you need to be very careful that you meet these criteria so that you can deduct that expense for tax purposes. Generally most revenue expenses which are incurred in the product incurred for business purposes qualifies, but generally capital expenses have a restriction. You cannot claim a capital expense. And what is a capital expense? An expense where the benefit lasts more than 12 months. That's a general rule. A benefit where the expense where the benefit lasts for more than 12 years. So generally, if there is a capital expense that is recorded, generally it is disallowed, but there are exceptions where exceptionally those expenses are also allowed. Let's go to the next slide. So like I said, there are specific deductions where the expense should meet certain qualifying criteria, then only those are allowed. So these are called specific deductions, and some of the expenses that we will look at is interest and the thin capitalization, allowance for trading stock, that is the stock deduction. Why it has a specific deduction is how you compute the stock, the costing methodologies. So all those are specified under specific deduction. Then we also have special deductions for research and development expense, where you have the normal deduction as well as an additional 100% deduction. So we will focus on that. And also there is something called a newly developing area where we see a lot of interest by the taxpayers. Marketing and communication expenses, which is advertising expense, where there is an additional 100% given if the expense meets certain criteria. So let's look at these expenses in detail. So first, let me go to interest. So interest, there are certain criteria as to how interest should be classified. What are the interest that qualifies for deduction? So I will not go into detail, but I will broadly say if interest incurred is for the business purposes, then those interest will qualify as a deduction. So then the only thing there is you must know what is interest, what qualifies. So all those are specified in the law. So I will also go to another important area called thin capitalization. Whatever the interest that qualifies under the normal laws get further restricted under a special section under section 18 called thin capitalization. That is where you have a formula where the law says that you cannot claim the full interest based on certain ratios. So what happens is, for example, there is an amount of interest that you claim that is recorded in the accounts, and that gets claimed in the tax computation. Then you have to go to the 18 to check the restriction. Section 18 gives a ratio based on the equity. The law says the maximum interest that you can claim is relates to certain ratio of the equity. So we will do a demonstration. Next slide, please. Yes, so we have an interest expense. So let me explain. This illustration will help you to understand. So we have taken three different scenarios where there are financial costs identical. There is 1 million of financial cost recorded in each three scenario. Your share capital and reserves in the scenario 1, it's 12 million, scenario 2, 12 million, scenario 3, 8 million. Total debt obligation on financial instruments. That is your total debt capital, 8 million, 12 million, 16 million. So the law says the maximum amount of interest that can be claimed has a formula. That is, you take the average interest cost based on your average interest expense and your average debt. You multiply that by the share capital and reserves. So if you look at scenario 1, the maximum that you can claim is 1.5 million, whereas you have claimed 1 million, so there is no issue. The full amount is deductible. Similarly, in scenario 2, the maximum you can claim is 1 million, so you have claimed 1 million, no issue. Scenario 3, because the debt capital is 16 million, it's huge, so there is a restriction. Maximum you can claim is 750,000, whereas you have claimed 1 million in the accounts. Therefore, 250,000 gets disallowed for tax purposes. Now, this is particularly important when you are expanding, or especially if your reserves are negative, when you are going through a period of losses. You always need to be aware and advise the management that the part of the interest can get disallowed. So rather than waiting till the year end, you can plan it upfront. You can do some financial restructuring, and because this can be substantial cost to the company when interest gets disallowed. I should also highlight this 250 that gets disallowed is not an immediate cost, because the law allows this 250,000 to be carried forward to the next 6 years. So you can carry forward to the next 6 years, but subject to the same limit, you can claim it. Beyond 6 years, the amount disallowed will be a cost to the company. So this is very important when you go for restructuring, when you go for loan, or you need to restructure your balance sheet to make sure that interest is not a cost. Next slide, please. Now we will look at research and development expenses. For the last few years, maybe 4 5-6 years, even during the previous law, research and development activity has been identified as a priority activity, where they are encouraging R&D activities in Sri Lanka. So there are certain definitions, certain activities like scientific, industrial, and other research, innovation or research relating to high-value agricultural products, even the process of developing the business and improving business products or processes are identified within the scope of R&D expense. So if you identify these expenses, only thing you need to identify them separately so that it meets this scope. Both revenue and capital expenditure would qualify, even if a capital expenditure would qualify as a deduction. On top of that, these expenses are given 100% additional deduction. So if you spend 100 rupee for tax purposes, you will get a 200 rupee deduction. Actual is 100, but there is a 200% relief for tax purposes. But there are also certain criteria in order to avoid abuse or manipulation. If it is scientific or industrial and other researchers, it cannot be an in-house cost. It has to be outsourced. It has to be undertaken by another institution, a research institution. But agricultural and other products in-house is also permitted. So what they want to do is, to establish this, what you need to do is you need to get a report from an external institution. Those costs you can claim 200%. Next slide, please. Yes, this is one of the very hot topics, very current and very useful. There are certain identified marketing activities. For example, before this provision came, all the expenditure relating to advertising other than capital nature qualified for relief. There was no restriction on advertisement or marketing expenditure. Now, what this section 15A introduced in the recent amendment seeks to do is it identifies certain expenditure and allows even capital expenditure to be claimed. So if it is a revenue nature, anyway, you would have claimed it. If it is a capital, now you have an opportunity under this MARCOM to claim the capital expenses. So I will just take one or two examples. It includes market research expenses by such person or any institution in Sri Lanka. Expenditure on development or production of marketing, advertising, and communication campaign to the extent that such development or production is carried out in Sri Lanka. Expenditure on advertising on mass media or even social media is covered. Expenditure incurred in product launches or campaign activities carried out by such person or local institution on his behalf. Expenditure on development and printing of point of sale material. Now, if you look at this, there is a common theme. Local institution in Sri Lanka, production is carried out in Sri Lanka. So there is an emphasis on Sri Lankan advertisement, that production should be carried out in Sri Lanka. So if that is the case, if you are doing advertising, the capital expenses will qualify. But that is not all. The biggest attraction of this comes in the next slide, where they say out of this, there are certain category which will qualify for another 100% deduction. So let's look at that slide. So this is the main section which captures out of what is captured, out of what is shown in the last slide, there are certain activities which are excluded from qualifying for another 100%. So what is that? Mostly internal marketing and salaries of marketing staff. So the emphasis is out of those activities, if you are doing a marketing or advertising campaign by using advertisement agency, and where the product which is advertised under adjustments I'm talking, product has a 65% value addition, you are entitled for 100% of your advertisement cost. So to put it simply, if you are doing some advertisement for a product which has it's goods or services, okay, both are covered. So if you are doing an advertisement campaign for a product or service which has a 65% local value addition, then you need to make use of this provision and record all those expenses. There is a maintenance of documentation which is very extensive, so you need to make use of this and claim the 100% deduction. We have seen so many local entities already doing that. So one aspect that you might have to do is, you might have to, practically how it happens is, first you identify the product which has a 65% local value addition. For example, a soap manufacturer who has a 65% product. Then you identify the marketing campaign advertisements that are attributable to this, and that you can claim it 100%. And I should also make a note that there is a gazette notice that is issued regarding the maintenance of documentation, because of this huge potential. Up to maximum of up to 500 million can be claimed under this. Maximum is 500 million. So the benefits can be very substantial. Because of that, there is a requirement for a very stringent record keeping regulation, where you have to identify marketing expenses invoice by invoice. List, and some of the requirements are listed down. There is a stipulated format in which you need to maintain the documents, and there are also certain restrictions to avoid manipulation. These marketing expenses cannot be paid to an associated person, and there are various restrictions which are mentioned in the previous slide. So there is an extensive and also foreign travel expenses cannot be claimed, and yes, it cannot be internal salaries of staff. So subject to that, basically, if you are doing an advertisement campaign through an advertising agency, you will qualify for this, and you need to maintain records. I think we are moving on to next slide, please. Yes, and this is also another expenses which allows capital expenses to be claimed. There is no additional 100% deduction that is provided, but capital expenses can be claimed. Agricultural expenses include opening up any land for cultivation or for animal husbandry, cultivating such land, referring with plants, the purchase of livestock or poultry, maintaining tanks or ponds, or the clearing or preparation of any inland waters for the rearing of fish and the purchase of fish to be reared in such tank, pond, or inland waters. The importance of this relief is, as you know, in agriculture, by nature, some of these expenses are capital expenses, like maintaining, clearing up land, replanting costs, so forth and so on. So by nature, they are, not, they have a benefit that goes beyond 12 months. So therefore, they have given this specific deduction, which allows the business to claim capital expenses. Moving forward, I think it's a capital allowances. I think Akila will take over from here. Over to you, Akila.
Thank you, Roshan. I think if the audience has any questions, we can take it up right now. We can take a 2-minute break for that to answer any questions that you have.
Akila, no questions.
No questions.
We can move forward.
Can I move forward then?
Yeah, you
Okay.
can. Yeah.
There are two questions posted in the questions box.
Right.
You can have a look, but if they're relevant, if you want to put them up.
Okay, wait. I cannot see questions other than the link given by the Feroz.
Wait a second. Let me. My apologies for that. Check now, please. Jivanti, you're looking at them here. You'll now have a questions dialog box. So I can read out the questions in the meanwhile. There is the first question from Dinuki, and she's asking, in Marcom, how do we calculate the 65% value addition? So Roshan, would you be answering this question?
Yes, I'll be answering. I'm glad that you asked this question. The Gazette specifies how this 65% local value addition should be computed. So basically, practically how it happens is you need to go to the level of each product category. For example, if you are a soap manufacturer, you might have a different brands of soap. So one particular brand, you need to identify the sales. So from the sales value, it's quite simple. Practically, there can be different difficulties in identifying, but theoretically, it's very simple. So from the sales value, you remove the raw material, value of the imported raw material. Then you further remove the value of locally purchased material, which where the origin is imported. For example, you're buying it from somebody who is a distributor who imports from outside Sri Lanka and gives it to you. So that you remove. Later, you remove any service component like royalty or any foreign consultancy that you have paid to outside Sri Lanka. So basically from the sales value, you are removing imported goods and services which are paid outside Sri Lanka. So it's quite simple. Complications can arise where you have common raw materials or common services that you need to attribute. So I think most manufacturers from the costing, you should be able to identify these components and remove it. So one complication is attributing common like packing materials. So you need to come up with a basis. As long as you have a justifiable basis, there should not be an issue. Service and common material attribution is an issue. Also, another challenge that we have seen practically is attributing the advertising expenses to individual products. Especially if it is a common brand, then you might have issue how to attribute to individual product. But if you are advertising by individual brands, right, then you should easily be able to identify this. Trust I have answered the question.
Yes, thank you very much. Jivanti, are you going to pick up the remaining questions, or shall I continue with the two other questions that have been placed now?
Yeah, one is, do these expense deductions means that the government will reimburse them, or we will get tax deduction on profit for the amount spent in such?
Can you repeat it, please, Jivanti?
Yeah. Do these expense deductions mean that the government will reimburse them, or we will get tax deductions on profit for the amount spent in such?
Yes. You will get a deduction from your tax, because when you compute your tax, you can deduct this. I'm not sure for which expense you are referring to, but if you are referring to Marcom, apart from the normal deduction, you get 100% additional deduction. So it's a double tax deduction, and your tax liability will get reduced accordingly.
Roshan, I think you need to say that there is no refund mechanism for that expense. It's only a deduction from when you're computing.
Yes, correct. So it's how you determine your profits. It's a deduction from your profit. So your liability comes down. So maximum your liability can go is 0. So there is no refund or anything. So if you're making losses, so your loss will increase by the deduction.
Roshan, I think the question is about the Markham and agriculture. So he's asking whether this deduction is like expense deduction means that the government will reimburse. This is in relation to those two adjustments.
Okay. There is no government reimbursement. You incur these expenses for business and you claim it as a deduction against your profits. So it will result in tax savings. Any other questions, Steven?
No, there was one question I answered, and that's all.
Okay.
Can I continue?
Yeah, Akila, over to you.
Okay. So we have been discussing on specific deductions before the brief Q&A session that we had. Now I'm going to take you through another specific deduction, which is very important in determining your taxable income. G, next slide, please. Okay. Now, the Inland Revenue Act does not allow you to deduct your accounting depreciation, which you charge to your profit and loss account, but instead you can claim something called a depreciation allowance. So what happens is the accounting depreciation that you've charged to your profit and loss account will be added back to your gains and profits or your profit before tax, and the depreciation allowance will be deducted from your profit before tax. Now, depreciation allowance will be granted to a person in respect of the depreciable assets which is owned and used by such person over the time periods which are specified in the Act. We will look at the time periods in the next slide. What is a depreciable asset? It should be used and owned by the person. It should be used in the production of income, and it's likely to lose value because of wear and tear. This will exclude goodwill, interest in lands, membership interest in any entity, and trading stocks. So now let's look at the time periods over which the capital allowance can be claimed. Okay, in the case of a building, you can claim your capital allowances for 20 years. Now, when you say building, it has to be a constructed building. You can't have sort of partitions and so on. And computers and data handling equipment, you can claim your capital allowance for a period of 5 years. And similarly, commercial vehicles, buses, minibuses, goods vehicles, heavy general purpose or specialized trucks or trailers for a period of 5 years. Now, when you say a commercial vehicle, it has to be a vehicle that is it has to be a vehicle used in the transportation or the rental business, or it should be a road vehicle designed to carry loads of more than half a ton or more than 13 passengers. So the Act specifically specifies what a commercial vehicle is. So if the vehicle doesn't fall into these categories, you can't claim capital allowances on that. Similarly, we have plant and machinery, furniture and fittings, and other equipment. You can claim capital allowances for 5 years. And computer software and intangible assets, excluding goodwills, you can claim it over the period which is specified in your accounting terms, the useful life, or if it's not specified, you can claim it over 20 years. Now let's go to an illustration and see how the capital allowance is claimed. For example, say ABC Limited started business on January 1st, 2021, and it prepares its accounts to December 31st each year. And the company has acquired the following assets: 5 computers on 1st of January 2021, valued at 100,000 rupees. So to compute the capital allowance for year of assessment 21-22 and 22-23. Now the 21-22 will be the first year in which you are claiming capital allowance on these computers. So how you compute it is you get the cost of the asset and you divide it by the number of years in which the capital allowance can be claimed. So that gives you 100,000 divided by 5 with 20,000 rupees. Now, the second year, that your depreciable basis would be not the cost of the asset, but the written down value. Now, how you arrive at the written down value is you get the cost of the asset and you deduct the depreciation allowance that was claimed, and that will give you the result as your written down value. So for year 2, which is 2022 and 23, you start off with your written down value and you divide that by the number of remaining years where you can claim your capital allowances, and that will give you the capital allowance for year 2. So over 5 years, you can claim your capital allowance over this particular asset, and by the end of year 5, you will end up with 0. G, next slide. Okay, so now that was the capital allowance part on your asset additions. Similar to your additions, when you dispose an asset, you end up with something called an assessable charge or a balancing allowance. Now, in simple terms, assessable charge would be your taxable profit on disposal. Balancing allowance would be your tax loss on disposal. So depending on the consideration you receive on that particular asset and the year of purchase of the asset disposed and also the written down value, you can end up with either a assessable charge or a balancing allowance. Let's go to the illustrations to see the two scenarios. Okay. ABC Limited started business on January 1st, 2020, and it prepares accounts to 31st December each year. The company acquired the following assets: 5 computers on January 1st, 2020, valued at 100,000, and the company sold 2 computers worth 40,000 on December 15th, 2021. So the year of purchase is the previous year of assessment, and we know that capital allowance has been claimed for 1 year on these computers that are disposed. So I'm going to take 2 scenarios. Scenario 1 is where the consideration received is 60,000. Scenario 2 is the consideration received on these disposed asset is 20,000. So let's take 1. The cost of assets sold. You sold assets worth of 40,000, and you have to deduct and the written down value on these assets would be 40,000 is the cost of assets disposed. Written down value is you have to deduct the capital allowances that was already claimed on these assets. So basically 40,000 divided by 5, which is the number of years that you can claim capital allowance on this particular asset category, and you multiply that by 4, which is the number of years that you've foregone to claim capital allowances. So that will give you your written down value. So to calculate the assessable charge or the balancing allowance, you take your consideration received. In this case, it will be 60,000, and you minus your tax written down value, which will give you an assessable charge of 28,000. Now this 28,000 will be added back to your profit before tax. That will increase your tax liability. Now the consideration received, if it's 20,000, Same scenario, cost of assets sold is 40,000. The tax written down value would be 32,000. And in this case, you will not get an assessable charge, but you will end up with a balancing allowance of 8,000. So this 8,000 can be deducted from your profit before tax, and that will bring down your tax liability. So similar to the accounting depreciation, if you have an accounting gain on disposal of capital asset, that gain will be deducted, and instead of it, you add back your tax gain on disposal. And similarly, it works the other way around as well. If you have an accounting loss on disposal of capital asset, that loss will be disallowed, and instead you can claim your tax loss, which is also the balancing allowance we call. Next slide. Yes, and the next part is on tax losses and how you can claim them. Roshan will take you through it in detail. Roshan?
Thanks, Akila. This loss section has become more complicated with the different rates involved because there are certain restrictions that you need to be aware of. So depending on your business activity, we looked at the rates in our previous session. There are business activities liable at 14%, 18%, and the standard rate of 24%. So if any of these businesses incur losses, there is a restriction on the set off of losses with subsequent periods or with different business activity. For example, if you are in the business of exporting and if you incur losses, and if you also have interest income in the same period, there are restrictions. The restriction is losses relating to business activities which are taxed at a lower rate cannot be set off against profits which are taxed at a high rate. So in the example that I mentioned, if an exporting company has business losses and also have interest income which is liable at 24%, the losses cannot be set off against the 24% interest. Therefore, even though the business has lost, tax needs to be paid on the interest cost without set off of losses. So 14% cannot be set off against 18 or 24. 18 cannot be set off against 24, but can be set off against 14 or 18. Same rate or lower rate you can set off. So when you are recording losses in the computation, or even when you are recording in the accounts, if you need a reference, you can segregate this and identify this separately according to the rates, because you might think there is a loss, but there are restrictions in the set off. And also losses incurred can only be carried forward for 6 years. Beyond 6 years, you have to write it off. It cannot be utilized. There are also restrictions on set off of investment losses against business losses, so which we have looked at it already under different topic. So the point I want to emphasize here is different business activity, there can be losses. One should not think just because there are losses, you can set off against the profits. There are restrictions. Next slide, please. Before I go to investment relief, is there any questions that I can take?
Yes, there are some questions. Jayanti, will you address these questions or should I?
Yeah, I'll read it out for Roshan. Is capital allowance available on vehicles used under finance lease agreement?
Capital allowances are available for finance lease agreements because the ownership under the previous law, there was no case of ownership. Lease assets were considered as a different category. Under the present law, even lease assets, there is a deemed ownership. So therefore, you can claim capital allowances depending on the assets. So the asset category is classified in Schedule 4. So whatever the asset on which capital allowances can be claimed, it is possible to claim capital allowances even though it is under finance lease. Jivanti, you want to add to this?
Actually, no, Roshan, I think you covered the thing. Under a different section, it's deemed that the ownership is transferred to the lessee. So on that basis, because in general terms, under the finance lease, the ownership is under the lessor, but in the Act, it specifically state that we have to be considered as as the ownership has been transferred to the lessee. So on that basis, we can claim capital allowances. And there's another question, Roshan. What is the tax benefit rate for capital allowances? That is depreciation allowance.
What is the
Tax benefit rate for capital allowances?
Okay, capital allowance are generally,
allowance.
depreciation allowance is generally a deduction from your taxable profit. So whatever the rate applicable to your business will be the rate that you get benefit. For example, if you are an exporter, the rate applicable will be 14%. So whatever the asset that you have purchased, you will get periodic payments over a period of time. So that into the rate applicable to the business will be the benefit. So basically the rate applicable to your business.
Okay. And Ayesh, I think your question is not clear. So if you can just elaborate more, or we can take that question later. And there's another question, Roshan. Do I need to pay tax for current year, even though I have losses?
No, if you are quite sure that the total estimate, when you say current year, I believe it's 31st March 2022. If you are quite sure that it's for the year it's a loss, you don't have to.
If your losses are sufficient to set off the entire taxable income, then you don't have to pay taxes. And
yes,
there's another one. Yeah. Then there's another one, Roshan. For computers, can office computers get tax allowances even if there is no direct production of goods or service involved? That is, computers are used to reply to customers.
It has to be used in the business, so it's not clear. I think it's very specific case. So you are saying there is no revenue, but you are using the computers.
Yeah, I think that's what is for
computers.
yes.
So yes, so the issue would be then you will keep on incurring losses, no? So whether there is a business and whether it's used in the business will be an issue because there don't seem to be a business income. So practically you will have a case where you keep on claiming, and it will keep on accumulating. So there can be issues.
There's another question, Roshan. Sri Lankan tax department calculates depreciation on assets itself from data provided by taxpayer, or it will consider client's calculated depreciation?
It's based on client's calculated depreciation because it's based on what you declare in your return. Whatever the asset which you declare in your computation supported by your financial accounts, so they will go based on that. So if it says plant and machinery, they will look for plant and machinery in the fixed asset schedule in the accounting. Based on that, they will do a review.
That is for additions, and the previous year balances, they can verify from the last year's return.
Yes, correct.
Okay. If it's used for after-sale services purposes, I think it's related to the same question relating to the software. If it is used for after-sale services purposes.
Yes, that's part of your business, so there is no issue. So after sales, so the revenue has already been recorded. So if it is used for after sales, it's part of your business. Therefore, you can claim capital allowances.
Okay. That's all, Roshan.
Okay. Now we are going to move into a very, very important relief, which you need to know the basics and the opportunities available. So you can go back and tell your management there are opportunities and there are time frames. Some of these reliefs are expiring in 2023. So all these are investment relief. So next slide, please. So I always had this problem, this expense relief and investment relief. What is expense? What is investment? Both are cash outflows. So how I illustrate this is, if you buy a gift to your lover, it's an expense. It's like an expense. But if you buy a gift to your spouse, it's an investment. But it's ideal if both persons are one and the same. So why I gave that illustration is, yeah, there are expense relief, but it's only for that year. You incur, you get a relief, or sometimes you get 100% double deduction, but it's still for that year. But investment relief lasts for over several years, and it can be very substantial. So let me take you through this enhanced capital allowances concept, which is under Schedule 2 of the Inland Revenue Act. It talks about an investment, a minimum investment of $3 million US, which you invest in certain depreciable asset. Almost all depreciable assets are covered, plant and machinery, etc., etc. You have to invest that in a new business, not an existing business. So I will come back to that. And the benefit that you get is you get 100% deduction of your investment made. So I have given an illustration below as to how this works. Because for many people, when you say tax holidays, they are excited. But when you say 100% deduction, they don't relate that to how it can be 100% and what are the benefits. When you say 100% deduction, you don't pay tax unless you have deducted the entire investment. So the entire investment means that's a payback period. So this relief is equivalent to an exemption which lasts till your payback period. So I've given this illustration. Now let's say you have invested 1,000 rupee in year 1 on plant and machinery. So you have these profits. Let's say they are adjusted already for capital allowances. You have claim capital allowances and you have profits in year 1 20, year 2 180, year 3 200, year 4 300, and year 5 300. So if you add all together, it's 1,000 rupee, which is your payback period. Year 6 is your payback period. 5 years is your payback period. So how it works is, in year 1, you will deduct this 1,000 rupee upfront. So you will end up with a carried forward loss of 980. Then year 2, you will deduct the balance, and you will keep on doing this until you exhaust your entire investment, which is your payback period. So this relief is very useful, and it's very flexible, because even if an exemption is given, it gives like 5 years from the commencement of business. So during the 5 years, 3 years, you might incur losses, startup losses, right? By the time you start making profits, your 5 year is gone. But in this instance, they make sure that you don't pay taxes on your payback period, provided it's less than 10 years. So after 10 years, these losses will expire. So you need to be aware of this. So let me come back to this new business. What is this new business? Now, for example, you're an investor, you are starting a company, you invest minimum $3 million, you qualify, no problem. But let's take an existing business. For existing business, they can't invest in expansion. For them, it has to be a new business. For example, a soap manufacturer, if he puts another line of soap, it's an expansion, it will not qualify. But if we put another manufacturing line to produce shoes or garment, then it will qualify. Or alternatively, what businesses do is they set up a new company. Even for expansion, rather than expanding from the same company, you infuse the money into a new company, then the Inland Revenue has no problem because they go by company. So if a new company, then it's a new business. So that's this second schedule to relief. It's a permanent relief unless the law gets amended, which is very useful relief. Let's go back to a temporary relief, which is under the Inland Revenue Act. Next slide, please. This is more or less the same style of enhanced capital allowances under Schedule 6. When I say enhanced capital allowances, these are addition to the normal capital allowances that you will get on plant and machinery or fixed assets. You have one deduction under normal capital allowances. On top of that, you get 100% enhanced capital allowances. This is valid up to 22-23. The investment is up to $3 million, not minimum, up to. So anything that you invest will qualify, provided you have the same criteria. It has to be new business. It can't be replacement of assets or expansion. It has to be new business, and you will get 100% deduction, same as the previous mechanism. You also need to be aware. Now, I have not gone into further details because this 100% is for Western province, but there are certain provinces in which you invest, you will get an additional 150 to 200% deduction. So you need to be aware of this. These are temporary enhanced capital allowances. Next slide, please. Yeah, next will be the payment procedure, which will be taken by Akila. Over to you, Akila.
Thank you, Roshan. Do we have any questions, Jivante, at this point?
No, Akila, no questions in the chat box.
Okay, fine. Right. So we can go to the next slide then. Okay, so now up to this point, we've been discussing on how to arrive at your taxable income and the various deductions that are available and the reliefs. So once you arrive at your tax liability, the next important thing would be how to discharge your taxes, or when do you pay your taxes. So by law, your tax will have to be paid on two bases, on installment basis and on assessment basis. On installment basis is where you estimate the tax liability for the entire year of assessment and you discharge it over 4 installments. The due dates would be, your first installment will fall on the 15th of August, the second one November 15th, third would be 15th of February, and the fourth on the 15th of May. Now, say you discharge this tax liability based on your estimation of your tax liability for your current year of assessment. And but when you finalize your audited financials, you might arrive at a different tax figure. So if that's the case, you still have a room to pay your final tax liability on the 30th of September. You assess your tax liability for the entire year. That's why you call it an assessment basis. And you discharge it on or before the 30th of September. And thereafter, your next obligation would be to file your income tax returns before the 30th of November. Along with your income tax returns, you have to file your income tax computation and your audited accounts. And also there are a few other documents that are listed out in the law. You have to file your returns before the due date. And once you file your returns on the 30th of November, 30 months thereafter, from the date of return filing, the Department of Inland Revenue can assess your tax liability and they can issue assessments. So after the 30 months lapse, they cannot issue notices of assessments by law. Next slide. Okay. Here I'm going to talk about one of the practical aspects that we come across. Now, in the case of a company with the accounting year ending 31st of March 2023, now, for example, let's take the year of assessment 22 and 23, where, as we discussed, the installment deadlines fall on the 15th of August 2022, and the second installment falls on the 15th of November 2022. Third one would be February 15th, and then fourth on the 15th of May. So when you pay your first installment, you have to compute your tax liability. You have to estimate it for the entire year, for your current year, and you discharge it every quarter. So during your first installment, if in the case of a March company, you will have your actual results up to June 30th, 2022. So you will have to estimate only your tax liability for the rest of the period. And when it comes to the second quarter, you will have your actual figures up to 30th of September, and the rest of the period will have to be estimated. Similarly, by third quarter, you will have your December financials, so you will have to only estimate for 3 more months. And by the 15th of May, you will have your audited financials ready by then, so then you can discharge your tax liability, your actual profit figures. In the case of a December company, you have a bit of an advantage there because the deadlines will not change, even though if you are a December company or a March company. Your first installment will fall on the 15th of August. By then, you have your financials up to June, and by the second installment, you have your financials up to September. So by the fourth quarter, you have your audited financials, and you discharge your tax liability. Next one. Yeah. Now here, what I wanted to highlight here is during one year of assessment or during one financial year, you have to discharge your tax liability, or you have to pay taxes for 2 years of assessment. There will be kind of an overlapping here. Say, for example, you are a company that has the financial year beginning from 1st of April 2022 to 31st of March 2023. Now, as you know, the first quarter payment, the fourth installment payment will fall on the 15th of May 2022, and this is relating to year of assessment 21-22. So even though you are in year 22, you will be paying taxes for year of assessment 21. And second quarter, and there also will be a first installment falling on the 15th of August 2022. This will be your first quarter for year of assessment 22-23. So this will be your current year. And then we have the September 30th final payment, which is also relating to a previous year of assessment. And finally, we have November 15th, which is again the second quarter of your current year of assessment. So you have to be mindful of your finances and how you sort of plan your finances in order to pay these taxes. Next slide. Yes, so along with your tax payments, there are a few compliance obligations that you need to do. Your tax payments should be paid on or before the due dates. Any late payments will attract penalties and interest. So penalties would be at the rate of 2% and interest at the rate of 1.5%. Penalties will be accrued every month. And also another thing that I wanted to highlight is the fact that you better not wait till the last day to discharge or to pay your taxes, because the Inland Revenue Department system, it recognizes your tax payment. It takes 2 days. So it's better to discharge or pay your taxes 2 days before the due date. If not, you might get these penalty notices and automated notices saying that you've not paid your taxes on time. And also there's another requirement to file an estimated tax payable. This estimated tax payable has to be filed with your first quarter first installment payment. You have to estimate the tax liability for the entire year, and you have to file it along with the payment. If you think that your profits are going to change, you can always revise this statement within the subsequent quarters. You have 3 more quarters to revise the statement and file the returns. And by 30th of September, you will have a complete picture of your financials. That is when you can discharge your final liability, as I've explained earlier. Next. Yes, and now Roshan will take you through a few new tax developments that will be in place from the year of assessment 21 and 22. Roshan, over to you.
Yeah, thanks. There are a few developments which we thought we should highlight, which becomes important for you to be compliant for the year of assessment 21-22. One of the administrative requirement is all this time online filing has been an option. Either you can manually file the return or you can file it online. But going forward from 21-22, it has been made mandatory unless they relax the rules later. So for the time being, they have said it's mandatory that all income tax filing for companies especially needs to be filed online. And another very significant change that has been introduced is the requirement to have separate accounts for tax purposes, not for audit purposes, for tax purposes, where the company has business activities which are taxed at separate rates, or if the company has an activity which is exempt. For example, if a company has exports and also has local manufacturing and local sale, the export profits would be 14%, whereas the manufacturing profits would get taxed at 18%. Therefore, the law requires that you separately identify these profits, revenues, and expenses and do a separate computation. The rationale seems to be all this time we used to do it on a pro rata basis. So now the Inland Revenue seems very keen to capture the real profits. They don't want distortions. So whatever, as far as accurately as possible, they want to compute and apply that. So please be mindful. You need to make changes to your MIS in order to identify separately if you have exemption or tax rates at different rates. I think that's the end of this session. In order to conclude this session, I would recap what we have done during these past 2 years, and then we will have the question and answer session. So if I can summarize, we started with the sources of income: business, investment, employment, and other. Then we saw how to compute the assessable income by doing certain adjustments, which we have looked at it today. Expense deduction, capital allowances, and various other deductions. So when we were looking at assessable income, we also learned about identifying a source in Sri Lanka and the importance of a source in Sri Lanka, because for a resident, irrespective of where the source arises, that gets captured under the local income tax net. Whereas for a non-resident, only income which has a source in Sri Lanka is liable. So for a non-resident, foreign source income is not captured under the tax framework in Sri Lanka. Then we looked at how to compute the taxable income and the different rates which are applicable. As I explained today, the different rates are applicable for many reasons. One reason is that if there is a losses, you need to separately classify the losses, because losses are attached to different rate bands, and there are restrictions in the set off of losses among different rate bands. Then we also looked at some of the exemptions in the third schedule, various exemptions, various sector specific exemptions and general exemptions. Then we started off this session with deductions, special deductions and normal deductions and special deductions, especially R&D and marketing expenses, where there is a 100% additional deduction is permissible by law. We also looked at a very important aspect, investment allowance, where if you invest a certain amount on new businesses, you get a relief equivalent to a tax holiday for your payback period. We also looked at capital allowances and the payment procedure. So the key takeaways should be tax management has to be proactive. Tax management is not a process that starts at the end of the year. Yeah, you look at the accounts and try to compute tax liability. It's an ongoing process which has to happen throughout the year. You need to be part of the decision-making process, where you help the decision makers to guide them. What are the expenses that will benefit them? What is the eligibility criteria? What are the incomes that are exempt? So all these you need to guide. So I've seen instances where the accountant is the last person to know about investment decisions already taken place. I've seen them. So I invite you to become drivers of change, to manage tax proactively, engage with your management, and add value to them. I thank all of you for your time and for your presence. And along with my colleague Akila, I wish you all the best. Thank you.
There are some questions lined up. Yeah, there are some questions lined up. Let's quickly take these.
There was a point mentioned as interest in land for the capital allowances. This was at the initial PowerPoint presentation. Please clarify same.
Land, there is no capital allowances, but improvements to land, if there is any building or anything, there is capital allowances available.
Yeah, I think he's referring to that. What is formula for calculation of estimated tax? How tax authorities ensure that estimated tax is calculated correctly?
That is, they quarterly send you a set form, statement, estimated tax, statement of estimated tax. So every quarter, based on the available information, that is, you need to be able to support this information, maybe quarterly accounts, you need to compute the tax liability for the entire year based on your quarterly. But subsequently, it might vary, but based on the available information, you should be able to calculate and pay taxes. Have I answered the question, Jivanti, or there is more to this?
Roshan, the department doesn't estimate them, so the onus is on the taxpayer to estimate for the year and then discharge the tax.
Correct.
Yeah, so the company has, just to answer, so the company has to estimate, lodge the statement of estimated income tax and discharge the tax. So if there's an amendment only, you need to refile the statement of estimated income tax each quarter. So that the correctness of it is with the taxpayer.
Actually, but if Indian Revenue requires to verify the accuracy, they can do it with the final return.
That is, if so once the final return of income is filed in November, yes, then the department can check whether the liability is correct. But you have correctly estimated.
Yes, also they can even call for information to determine how you have determined file the set. They can ask for supporting documents, your quarterly accounts, everything. Any other question?
Devanti, I think you missed these questions. There are 4 more questions. I will read them out.
Okay.
There's this one question. For computers, can office computers get tax allowances even if there is no direct production of goods or services involved? That is, if the computers are used to reply to customers.
I think we respond to that question.
Yes, so to answer that question, yes, as long as they are related to the business, you can. I think there was another subsequent one. Yeah, they talk about after sales services. So I said after sales services is part of the business. Therefore, if the computers are used, then you can claim capital allowances.
Okay, I think we're done. We're done
now.
Okay,
there was
Devanti.
one question. For computers, can office computers get tax allowances?
Yes, office computers, yes, owned by the company, yes. So there is capital allowances available.
Yeah, I think we have answered all questions. I'm just checking again. Yes, sir, we answered everything.
Okay, if there aren't any questions, can we get some feedback from the participants regarding today's session or how the series is going so far for you? Okay, yep, Kakundi is saying learning and grasping new concepts. Shakil Ali is saying very informative session. Zara Azam missed the interactiveness of participants too. Zara, well noted. We'll take care of this request in the next session. I'll try to unmute some participants if they want to ask questions. Thank you very much for this session. It was very useful to us. You're welcome. Overall, very informative. Thank you to all. Very knowledgeable session. Thank you, EY Sri Lanka. Yes, thank you so much. Only the source file, it doesn't have the links for the recording. Mehrkant, what you're going to do is you're going to download the list of contents file. That is an Excel file. It has all the links for the recordings, and I usually update that file the following day of the session. So it will be uploaded tomorrow morning. You will be able to download that file now and tomorrow as well, but it will be updated tomorrow. No problem. Okay, Roshni, do you want to add something?
Not really. Just thank you to all the participants, and it's good to get all the questions, and hopefully we answered them as well. And thank you to my team as well, and thank you to ACC. And we'll see you all next week. We'll be doing so on Tuesday. We'll be covering realization of assets. And we'll also start on value-added tax as well on Thursday. So see you then and have a good evening.
Yes. Thank you so much. Thank you so much, Akila, Vipash, Jivanti, Roshan, and Roshni yourself. Thank you so much for this session. See you guys in the next week. Until then, have a good day. Have a good weekend.
Thank you all.
Thank you. Bye-bye.